What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is February 20th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about what I believe is the cold reality we need to wake up to when it comes to crypto markets. I understand that a lot of people are feeling a wave of FOMO right now with the relatively optimistic price action we've been seeing since the start of the year, whether it be in Bitcoin, Ethereum, or altcoins. But I want to go ahead and explain the important dynamic that so many people don't focus on in regards to supply and demand. If you guys have the time, I highly recommend you guys watch this video. It's going to be one to remember. And if you like the video, consider dropping a like. It's one of the best ways you can support the channel. We've also got a sponsored review of Minima later on in the video. Really exciting layer 1 blockchain protocol, so stay tuned. You guys won't want to miss it. Okay, let's go ahead and kick things off. I want to first start by saying that I understand the sentiment people are feeling right now. I want to make that very clear out the gate. When I'm looking at not just the daily time frame, but the weekly time frame, I'm starting to see on these longer term time frames that price does look pretty optimistic here. We've seen all of the initial steps that I'd want to see, or most of them at least, that would start to signal that feeling of, hey, we might be stepping into a new bull market, right? Seeing how price has been pushing up against that 200-week moving average. We've cleared through the 200-day, and even our key momentum indicator, which we utilize for members of the Dash report on the weekly, has held a pretty consistent blue flip here of positive momentum. So I completely understand where people are coming from and feeling that kind of itch of FOMO and not wanting to miss out on a potentially next bull market in the crypto space. And I understand it's not just Bitcoin. We've seen clearly within total market cap the same trend here, as total market cap has led overall valuations or market cap for crypto to its highest point since August and back above that 200-week moving average. But I want to go ahead and again remind people to not get sidelined or sidetracked by the short-term price action. Now, there is a lot of importance to TA. We utilize technical analysis here on the channel. And again, I'm making it very clear here that on a TA perspective, at least according to traditional technical analysis terms, things are looking pretty optimistic. Go ahead and say that here. And to be honest with you guys, while we have been in cash and we sold out of our positions roughly around where we are right now, yeah, sure, could we have bought back in January before the rally? Sure. Could we have bought after the collapse in valuations in FTX? Sure. And we missed that trade, if you want to say it that way. But I'm not here again to make short-term trades. I'm here to swing the next cycle. I want to trade the next bull market. And trust me, as much as the next person, I don't want to miss out on it as anyone else. Right? So what's the catch here? What's on my mind? I know a lot of you are probably wondering, what's holding me back? And it has to do with understanding the important dynamic that I've understood as far back as the past 4 or 5 years since studying the core fundamentals of Bitcoin in events like the halving event. Now, I'm not going to be focused so much on the halving event in today's video, but I want to talk about how the supply dynamic that the halving event has works both ways when it comes to asset prices. So let's go ahead and take a step back here. As many of you guys know, with the halving event for Bitcoin, usually there's every 4 years, there's a halving in the amount of new Bitcoin that gets minted per block. And that usually has led towards this supposed supply shock that drives the next bull market. It's why Bitcoin works in a very cyclical way, at least throughout the last decade of easy money, where Bitcoin was seen as this high growth risk on asset during an era of excess monetary policy. Now, while that works on a positive side for Bitcoin, one of the big problems that a lot of Bitcoin bears would always run into is they'd say, but Nick, isn't the halving event already priced in? How can this be a bullish catalyst for Bitcoin? And I would always argue to them that, look, guys, we may know the halving event is coming and that data is publicly available and ready, but you can never fully price in the day-to-day changes in supply and demand until they happen. Right? Some people, more effective markets might price it in better than others, right? But when you have a halving in the overall introduction, the main inflow of new introduction of Bitcoin, that is only going to be able to be truly priced in when it happens. Because when you have that effect, when you have that reduction of new Bitcoin being created every 10 minutes, this has a major change on the daily inflows and outflows. And it's what allows for that initial kind of cyclical move to the upside, where then FOMO and the broader retail trading crowd, as well as new institutional investors, drive the mania and the rally. You need that initial spark that essentially leads there to be more demand consistently than available supply in the market. That's what's caused a lot of the previous bull markets. You can chase any narrative you want. That's usually how it works. And I think that most Bitcoin bulls and people who are long-term investors agree with that to some degree, that it's not just priced in. It happens when it happens. So we need to understand that dynamic in both directions. And this is where it comes full circle. Because while we can't so much price in this kind of bullish development, right, when there's the next halving event and the next halving event for price, right, that only happens when it happens. We need to also think about the other perspective. First off, on the topic of the halving event, the halving event is getting weaker and weaker over time because the amount of reduction in the Bitcoin supply, while it's always 50% on the introduction of new supply, that amount of new introduction supply is becoming less and less valuable in answering this question. And it's more about whether or not the vast majority of Bitcoin, which are already out in circulation, whether or not there are more buyers than there are sellers, at least to keep prices, where they are. That's one dynamic we need to consider. The halving event, the bullish catalyst that we used to depend on every 4 years, is getting weaker. But we have two really big things that tell us an even bigger question, as we were alluding to. Are there more buyers than there are going to be sellers over the next year or so? On a day-to-day basis, are we going to see more market order inflow versus outflows? Well, personally, I got to tell you guys, I think there's going to be a lot more selling than there is buying. We not only are on a generally risk-off environment, which is going to dry up a lot of the liquidity as the Fed is engaging in quantitative tightening and people are buckling down for a recession, but we know to a numerical degree what kind of sell-side pressure we could be dealing with, some kind of estimate of what we have to work with. And there are two big catalysts that could weigh down price over the next coming months. First off, let's talk about Mt. Gox, or Magic the Gathering Online Exchange, the traditional legacy Bitcoin exchange that was hacked back many bear markets ago and has been one of the biggest red flags or warning signs of potential capitulation during this bear market as we approach the period of time where creditors are going to be receiving one of two options to be recompensated for the funds that were recovered. Now, just to put things into context, over the past week, there was a lot of excitement as headlines rang out over the past few days that the two largest creditors, over 20% of the holdings on Mt. Gox, were deciding to take a secondary payout option that would allow them to receive 90% of their funds in the form of Bitcoin rather than through a forced liquidation in cash to the original holders who had Bitcoin on the exchanges. Now, this has probably been the biggest reason Bitcoin is moving up in its price over the past week or so. This has been a pretty big development that I think gave Bitcoin that second wind back up to the 200-week moving average. But I want to go ahead and talk about why this isn't really a bullish catalyst. If you go through the article and actually understand really the concept of what's going on here, you have a defunct New Zealand-based crypto exchange, Bitcoinica, and the Mt. Gox Investment Funds Trust, or MGIF, claiming basically a fifth of all Mt. Gox claims, so about 21% of the funds that were locked on the platform, and they're going to be getting 90% of their original funds paid out in Bitcoin as soon as possible, versus playing into the longer term liquidation process, which could take multiple months to a year. So if we go back to that point about talking about what really affects price, it wouldn't be something that's, let's say, for example, they took the other option and they kept their funds locked up. That's not going to have an effect on price. That's why Mt. Gox's claims have not had an effect on price for a long period of time. But they're instead opting in to take 10% off the table so they can get Bitcoin immediately. Now, a lot of people say, they're just doing that because they want to have it under their own custody. They don't want to deal with the legal process. I gotta tell you guys, that sounds to me like they want to start distributing. They want to start selling. They want to get out of those positions because they know that Bitcoin has made monstrous gains since Mt. Gox went defunct, over 20x from where it was at the time, more than 20x from the previous all-time highs. And on top of that, they know that the longer-term trend for Bitcoin might be challenged in an environment where the Federal Reserve is continuing to tighten and fight inflation. So that already alone, just to kind of put some numbers out there, is going to be at a point where we're going to have 141,000 Bitcoin that come through and could be potentially on the market. But even just for that 20%, that's over $700 million of Bitcoin that could be on the open market. It may not sound like much, but that definitely on spot markets has a pretty big weighted impact. And you need to simply ask the question, in order to stay afloat with where we're at right now, can we get $700 million of additional buy-side liquidity? That's an important question that you need to ask yourself. Again, it's something, I'm not here to say there's some ultimatum. No one knows. Warren Buffett could be bullish on Bitcoin tomorrow. But do you want to take that bet on it? Do you want to bet that there's going to be some Ray Dalio type investor coming in, or Stanley Druckenmiller coming in and buying up that equivalent amount of supply, or a cohort of investors? Right? Again, you got to ask that question yourself. But also consider this as well. That's just one key thing we need to worry about. The next thing we need to talk about is even bigger. And it's one that unfortunately gets lost in the conversation too many times to count. And we've talked about it time and time again here on the channel. It is the continued grayscale discount in the GBTC product. A lot of people, unfortunately, have a very short attention span when it comes to these kind of items, and they mainly focus in on price. I'm not meaning to be insulting here. It's just it's a continuous thing I see in the crypto space where people were talking about the, and we even covered it here, even though it was going against our longer term thesis and argument. The grayscale GBTC discount was actually waning. It was starting to get up, and people were starting to pay at least a higher premium or get it close to the original net assets under value. Now, again, for those who may not know, the Grayscale GBTC product is an exchange-traded note. It allows you to buy Bitcoin through a brokerage account. It comes with like a 2% annual fee, a maintenance fee. So it allows people to have easier access to crypto from their brokerage account. And the thing is that there's actual, supposedly, according to Grayscale, there's spot BTC behind each share. Well, over the past years, we've been seeing a growing discount trading on these shares. And while a lot of people would point to the fact that Grayscale may not have all the Bitcoin they claim, and therefore that's why it's at a discount, I like to put that aside and really focus on why there is this difference, why there is this overall discount. The main reason, I think, is not just because they don't have all the Bitcoin backing it, but more specifically, that there is way too many shares issued per demand in the market. There is a lot of Bitcoin that Grayscale purchased back during 2020 and into early 2021 that they've been slowly trying to sell off. They've only liquidated about 25,000 Bitcoin from the peak, which was around 655,000 Bitcoin, and now sits at around 630,000 Bitcoin. Okay, so again, if Grayscale ideally wants to close this gap, although it doesn't have to be this way exactly, if there is more demand, hey, that's good, right? But right now with current demand and supply, we're seeing that the rate is setting somewhere around 46%. So even with the optimism we're seeing in the market, the premium isn't gaining, right? They're still around the same discount. So if we apply some simple mathematics here, although again, I don't want you guys to think this is absolutely final, right? But with current supply and demand balance, right, in order to close that gap, Grayscale essentially needs to liquidate or see a demand increase of around 289,800 BTC over some period of time. That's an excess supply that Grayscale has on the books of about $7 billion. That's a lot of Bitcoin. And until we start seeing a premium being paid on this, people taking advantage of a Bitcoin that they can get access to, or a allocation of Bitcoin at a 46% discount, tells us that we've got a big difference between supply and demand. And you don't think that there's a chance that Grayscale or the holders of Mt. Gox or holders through Celsius or FTX, once they get access to some of their funds over the next couple of months, aren't going to take advantage of the optimism we're seeing and add in to the sell side pressure? You also have to ask on the other side of the equation, on the buyer side, who's going to come in? Are banks going to buy Bitcoin after everything that happened in this space over the past 2 years? What new narratives are going to get even retail investors excited outside of pure speculation? I'm just trying to be realistic with you guys here. We, for example, and I want to make it very clear, this is something we're very proud about. Back in the last bear market, we bought Ethereum practically at the lows. We called it the golden range of opportunity between 80 to $100, and we nailed that bottom. We've made some wrong calls here on the channel. I'm not here to say that we're absolutely perfect. No one is. Anyone who claims so is usually lying to you. But the big thing here is this. We know how to spot capitulation. That is something that I have to say I think we excel at here. We've been able to buy in when the trend is strong, buy in during periods of capitulation, and although we didn't time the top perfect this time, I gotta tell you guys, if people think this is the end of the bear market, I think they got another thing coming to them. Again, take a look back at total market cap. We've already had this happen before where we went below the 200 week, right? Went right above there, deviated, and went right back down to new lows. I think we're going to be chopping in this range for a long period of time, and you're going to get some opportunities to get Bitcoin down in that low range again. Perhaps not at 10K, perhaps not at some absurd level like 5K or something that's really far from where we are. I'm just saying that I think we're going to get somewhere back down in this range, and that this could be a fake out in the near term. And one of the big things as a kind of closing remark here that I think is important to keep in mind is taking a look at the US 2-year Treasury yield. Now, we've talked about these treasury yields here on the channel, but I just want to go ahead and talk about how consistent this has been as an indicator alongside, the yield curve inversion, some of the other dynamics we talk about within bond markets, right? As you can see, both times where the Fed pivoted back in 2000, actually the past 3 times, my apologies, in 2018, as you can see, the 2-year yield chased what the Fed was doing, and only here in March of 2020, when it was back down to rock bottom, that was the time to buy equities on a dip. Same here as well in 2006. Early stage signs of Fed tightening starting to cease and starting to go back into easing. And only here in October, November, when rates were back down to practically below 1% versus the 4.9%, was it time to go long equities. And take a look back during the dot-com bubble, right? If you want another example of this, right? We saw here from 2000 going all the way down to 2003 where equities finally bottomed. That was when it was time to go long equities. We are still highly suspended, showing no signs of declining on the 2-year yield. And on top of that, just this past month, we did something that we didn't do the last 3 times. We had a major uptick reversing the past prior months of losses for the 2-year yield. Now it's up 10%, right? Made a 10% move on the yield back up to 4.623%. This did not happen the prior times. And I think it's a clear sign that we are entering into a decade of difficult times where there is no clear, consistent uptrend in assets as the Federal Reserve has to continue tightening. I'm not saying it's going to be Armageddon, but it's going to be a difficult time where you can't just buy the dip, hodl, dollar cost average. All of those mantras that worked over the last decade, I do not think are going to work this time around. And there are a lot of people telling the other narrative that it's going to work, you got to buy the dip, you can't miss out on the opportunity. But I got to tell you guys this, the thing that differs a really good investor or trader from the broader crowd is someone who knows not to chase every trade and rather think not about what they can make, but what they can lose. And I'm going to keep emphasizing that point here on the channel, guys. It is a huge differentiating factor for us here on the channel. And I think that it's very important for us to continue maintaining that mindset here as we go throughout the preceding months. I think one important thing here, again, is we are going to be diving into over the next couple of weeks is we're going to continue to keep on top of Bookmap. This is one of our tools here that tracks that market order flow. As of now, as you can see on a day-to-day basis, positive market order flow reflecting in positive price action. And when we start to see those signs that price action is holding out relatively thin, maybe there's bid support holding it up, but you're seeing that market order flow turn negative, that's when things start to get bad. When you start getting week by week, the 7-day trend of market order flow starting to signal red, that's when you can be pretty confident that the trend is ready to start fading. We're not saying we're short here, but we're definitely keeping an eye out on that market order flow. And we are still remaining comfortably in cash. I'm not feeling an inch of FOMO here when it comes to the market. And I know that until I start feeling a little bit of FOMO like that, we may continue for a couple more days or weeks. We may deviate above that 200 week. And you got to be prepared to stomach that and wait to see whether or not it can hold on that 200 week. Because if it can't, if it deviates back below the 200 week, you can say goodbye to the bull market hopes and wishes that so many people are championing right now. So anyways, guys, if you guys like this core part of the video, drop a like. It's one of the great ways you can support the channel. And let's go ahead and dive into this really exciting review of Minima. Alrighty, everyone. So in today's sponsored review, I want to spend some time to talk about a really exciting layer 1 blockchain network that's not only aiming to radically change the way we think about consensus in the crypto space, but on top of that serves as a foundation for some really exciting applications to be built that can provide a lot of value within the crypto ecosystem as a whole. Today, I want to spend some time to talk about Minima. Now, for those of you who are hearing about Minima for the first time, they're aiming to simply be the first mobile native layer 1 network in the crypto ecosystem with smart contract capabilities. Its aim is focusing on bringing back the power of consensus back to the end users of the growing network, rather than being reliant on a certain cohort of miners in the case of proof of work, or a large cohort of stakeholders in the case of proof of stake. So we're going to be talking about how this consensus mechanism or distributed proof of work really works, and how it allows Minima to maintain a truly decentralized network. And outside of that as well, talk about some of the really interesting capabilities on top of the Minima network when it comes to its actual smart contract development. So without further ado, let's go ahead and dive straight into it. Now, it is important for you guys to have a kind of high-level overview of what Minima's network is made up of. There's not one specific layer to Minima. There's a couple different layers that allow it to offer the services that it offers within its network. You of course have the main settlement layer, Minima, which serves as the layer 1 network. So think of this as the core layer 1, similar to that of Bitcoin, Ethereum, or any other type of different network out there. It's the core layer where there's finality and major settlement of transactions. But on top of that, for smaller transactions, as well as different types of applications, there are two other key layers here. The Maxima layer, which serves as the transfer of information off-chain, and on top of that, the Omnia layer 2 scaling solution that allows for rapid throughput of transactions. This utilizes core technology that's similar to that of the Lightning Network, which has proven really valuable for Bitcoin in the long run. So these two networks allow for some really exciting things, which come into play through the layer 3 or the mini dApps layer, where Web3 applications can actually be built. Things such as encrypted peer-to-peer messaging apps, as well as different types of DeFi applications, can be built and used within this application layer. So this is the core framework here of Minima. And if you guys are interested in learning a little bit of details about how they actually function from a technological perspective, don't just take my word for it here. Definitely check out the technical documentations. I've taken a good read through them, and they provide a really good framework about how each layer plays and interacts with one another. But the big thing I want to focus on here, and this is really where the big bet is for Minima, where you're either going to be a fan of it or not, and that has to do with the consensus means of Minima. And I have to tell you guys, I actually think this is a really exciting new approach to consensus that we haven't truly seen within the crypto space. And it's something that's been kind of itching at me in the back of my mind for a long period of time. Because if we think about any type of crypto network, the most important thing that matters, you might have the greatest branding, you might have the greatest features or functionality when it comes to building applications, but if you don't have consensus right, this is where things can go wrong. And if we take a look at proof of work or proof of stake, while they are not, absolutely perfect systems, it's important to understand the pros and cons that come with them. Sure, they've serviced the crypto space for a long period of time, but it's important to ask some big questions. And one of them being whether or not we can really rely on a cohort of actors simply follow being good actors as validators. So what do I mean by this? Well, sure, proof of work and proof of stake as two major consensus mechanisms have worked quite well over the past decade within the crypto ecosystem. But there's one big problem. Not only is there a chance of a potential double spend if there is a majority of miners or stakeholders that coerce together in order to take advantage of such a situation, but on top of that, the big fear we have here is censorship. The question of whether or not actors on these networks would censor certain players from spending or utilizing the network in some shape or fashion. And this goes against the question of decentralization. So we need to really think about what system can actually provide that. And that's the big focus here with Minima. It focuses on decentralized or distributed proof of work, where essentially people on their mobile phones or desktop applications would be able to run a very simple proof of work system or node within the network by allowing a large cohort cohort of different participants within the network, a growing network of users to be able to actually have control over consensus. And that's really where Minima stands out and allows for some really exciting applications. But on top of that, the high degree of scalability, as it doesn't require that you go out and buy a large ASIC miner or be a large stakeholder of a given coin. It's open to everyone. Everyone is equal on the network. Now, I know a lot of people are curious as well about how does this basically prevent against spam transactions or people going out and buying up a bunch of mobile phones or devices and double spending on the network. The important thing to understand is that through utilizations of technologies like Hashcash, created by Adam Back, who is a big Blockstream contributor in the Bitcoin space, as well as different things such as the burn mechanism, not only does Minima prevent spam transactions, but they can prevent this attempt at double spends by having the large-scale network with a large scale of users be able to actually prevent these things from happening. So it's a really exciting approach comparative to other networks that we've seen out there in this space that have potentially attempted something similar to this, or at least have had this idea of a more distributed network rather than being trusted on just a few miners or stakers. And on top of all that as well, there's the framework to build really exciting mobile native decentralized applications that you can also as well utilize on desktop. Now, Minima right now is in its early stages, but it's already got some really exciting applications that you can dive into, as well as an entire framework such as its native KISS scripting language, which allows you to build Turing-complete smart contracts, similar to that you might find on the Ethereum network or other EVM-compatible chains. But on top of that, allows you to build front-end applications with the core language in familiar languages such as HTML, CSS, as well as JavaScript. So some of the most popular programming and development languages out there on the market, and a really intuitive native development language for building smart contracts. Now, some of the applications that have already been built are quite interesting. They already have a native wallet. They have the native incentive program, which allows for people to benefit from running a node on the network and contribute to the process of consensus. But also they have Max Solo, which is a peer-to-peer chat application running over the Maxima network, allowing for private peer-to-peer messages, as well as Future Cash, which allows you to basically store cash for the future, put away money on the network, and all types of different other functionalities when it comes to personal finance. It's kind of an initial stage DeFi application alongside the peer-to-peer messaging application, which allows us to start to see that Minima isn't just going to be about DeFi. It could also be about day-to-day applications that might reach a completely different audience that isn't so in tune with DeFi, yield farming, all the kind of stuff that goes on within the crypto space. So this provides a really solid framework, and you guys can go ahead and test out some of these applications, give it a go, try to get a feel for what Minima offers through its native programming languages. But this is really exciting to see that out the gate, there's already all the key infrastructure for Minima to be able to be utilized, to see people build and test applications, but also to see that the possibilities can really expand out far beyond the kind of applications we traditionally saw that may be even more familiar to the kind of Web2 applications that we've known about, with the ecosystem benefits of Web3 applications and the decentralized aspects that make Web3 apps so powerful. Now, one other big thing that I highly recommend you guys do as you go throughout your journey is to check out the docs section. One really big thing about Minima that I like is that their docs are very well written out, and you can start to get a really good understanding about what Minima has to offer as a network, from the in-depth layers that build up the entire network, as well as consensus. I think for the first time in crypto's history, we have a project seriously taking this approach towards distributed proof of work. And you can tell that the team has put a lot of thought into the concept, whether you're looking at the documentation or the white paper. But on top of that, the key levels of inspiration that they pulled from various different types of networks or concepts that have existed within the cryptography community for some time, pulling together a lot of interesting concepts and incentive structures. Now, one big thing I want to spend some time to discuss is the burn. Now, why is the burn important? And the name itself might already kind of give you some hints of the deflationary aspects that it offers. Well, sure, there are definitely some similarities to draw here. Many of you might already know about EIP 1559. This was one of the proposals that got implemented on the Ethereum network that added deflationary pressure to the network by taking some of the fees paid to the network validation that go into an address that basically removes them from the circulating supply. This is a deflationary thing, and it definitely does benefit Ethereum. But one big thing that Minima has that Ethereum doesn't is not only the deflation of removing some of the circulating supply when fees are paid on transactions, But on top of that, not having to pay any of those fees back to the validators of the network. So the thing is, because we're no longer reliant on proof of work validators, i.e. miners, or large stakeholders, i.e. proof of stake network, and are using distributed proof of work, everyone gets to run a validation node, but no one's being rewarded specifically for it, directly at least in the form of fees. All fees essentially get burnt. So the more usage of the network, it all goes directly into lowering the circulating token supply. And that is a really interesting concept when you think about it, especially when you're considering Minima as an asset. The more utility on the network leaves a strong incentive for propagation and processing of transactions. Along with that as well, it's a great way of ordering transactions on priority. So the higher the burn or the higher fee paid, essentially the quicker transaction will be validated. This is how transactions work when it comes to Bitcoin and Ethereum and other types of networks through the fee market structure. And last but not least as well, it's a form of preventing spam on the network. Right? So there needs to be some kind of fee structure here to make sure that valuable transactions are the only ones being processed and that bad actors can't form a DDoS attack essentially on top of the network. So this is, again, a really exciting concept. And again, from a monetary policy perspective, the more utility there is in the network, the shorter the supply. And that should eventually lead, hopefully, towards benefits for the underlying asset. It is simple economics that we have to consider. But all in all, this is really exciting, and I'm excited to see where Minima goes in the long run. There's definitely some questions I still have. I'm definitely interested to see what kind of applications people are going to build. There's some definitely great example applications that have already been built, but I'm curious to see how Minima is going to build its community long term. So if you guys are interested to potentially dive more into it or potentially see whether or not you want to build applications within the Minima ecosystem, I highly recommend you guys check out the documentation on Minima's website at docs.minimal.global. I'll leave a link down below in the description where you can learn more about the network, learn how to participate in the network by running a node, as well as learning how to build applications or become an ambassador. And outside of that as well, I highly recommend you guys follow them on Twitter and major socials, but I'll leave the links down below in the description where you guys should be able to find all those resources. I think there's a lot of potential to the concept of a distributed network, and I'm really excited to see whether or not this can become the new standard in the crypto space, and if the language framework allows for some really exciting applications to be built on Minima. That's it for today's review, everyone. If you guys like this video, consider dropping a like, checking the links out down below in the description if you want to learn more. But until the next video, everyone, I'll see you all in the next one. Take care, everyone.